So, just a few days ago, Donald Trump suddenly announced that the United States would impose an additional 100% tariff on Chinese goods starting in November, a move he claimed was in response to China's sweeping new export controls on almost everything that they produce. And right after that announcement, the S&P 500 plunged 2.7%, wiping out nearly 2 weeks of gains in a single session. It was the worst drop since April. But then, just 2 days later, Trump tweeted, "Don't worry about China, it will all be fine." And just like that, the S&P 500 jumped 1.6%, marking its best day since May and recovering more than half of its losses from Friday. And not just 2 days later, Trump accuses China of not buying US soybeans and causing difficulty for the soybean farmers. And that is an economically hostile act. Ah shit, here we go again. By now, this has become almost predictable. Trump threatens tariffs, sometimes the market panics, other times it doesn't, and when he walks it back, stocks would sometimes rebound sharply. This cycle has repeated so many times that it has even earned its own Wikipedia page. Trump always chickens out, or taco. In fact, Forbes counted that since Trump took office till July, he has already flip-flopped 28 times, often within just days of making a threat. To illustrate just how predictable these swings have become, Corbett later have even created the taco trade playbook, outlining each stage of the cycle, from Trump's tariff threats to the sell-offs to his reassuring tweets and finally the relief rally that follows. As of this week, we have reached step 8. After the Monday Open, Treasury Secretary Bessent appears on live TV and reassures investors. And sure enough, that's exactly what happened. So with another round of tariffs just announced, we might be heading into the next taco moment. And if you want to spot and act on this kind of trading opportunities in real time, the Momo platform makes it super easy to do so. Firstly, Momo supports 24-hour trading in US stocks during trading day, so you can act on opportunities the moment they appear. And to keep you updated, Momo also delivers 24-hour news alerts, notifying you instantly when major market events happen. Secondly, Momo lets you set custom stock alerts from target prices to technical indicators, so you can stay on top of the market without constantly staring at your screen. Thirdly, you can use Momo AI to analyze your portfolio and uncover potential risks and opportunities. You can even ask questions like, "Will Trump's tariffs affect my stocks?" to get instant data-driven insights. Momo AI is built on Momo's extensive financial database and real-time market news, which means it is useful whether you are just starting out or already an advanced investor. New users who sign up to Momo SG will get to earn up to $1,315 worth of welcome rewards when you fulfill the terms and conditions, which includes a $60 worth of Nvidia share. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Now, even though the taco trade pattern might seem amusing, it also reminds us that in the short term, markets are driven far more by emotion than by logic. One moment, investors are dumping everything in fear of an escalating trade war. The next, they are piling back in after a single reassuring tweet. For most people, this would have been just another day in the market. But if you have been investing on leverage, this would be your worst nightmare. On Friday, more than 1.6 million crypto traders were liquidated, as cascading sell orders triggered one of the largest liquidation events in crypto history. Stories of traders losing their entire portfolios began surfacing online, with some even taking to unaliving themselves. That's why for most investors, the smartest thing to do is to step back from the chaos of every taco moment, from tariff tweets to policy pivots, and zoom out to the bigger picture. Which brings us to this question. Realistically, how much longer can this bull market last? Market strategist Tom Lee calls this the most hated V-shaped rally ever, because despite markets climbing relentlessly higher, many institutional investors remain deeply skeptical due to many looming uncertainties like the FOMC's next move or the threat of new tariffs. Meanwhile, MarketWatch has also called this the dumbest stock market in history, arguing that the rise of passive investing has led investors to pour money in blindly, often ignoring valuations or fundamentals altogether. But as the saying goes, the market can remain irrational longer than you can stay solvent. History proves this over and over again. For example, in 1996, the then Fed chairman Alan Greenspan famously warned that markets were in a state of irrational exuberance. Yet, stocks doubled from there before finally crashing in 2000. Likewise, in 2005 and 2006, the economists and several analysts warned of an unsustainable housing bubble, and still, the markets gained almost 30% over 2 years before it all finally unraveled in 2008. Fast forward to today, even after a remarkable 89% gain since the 2022 bottom, this bull market is only about 3 years old. Historically, bull markets tend to last much longer than that. For example, the 1987 to 2000 cycle lasted for nearly 12 years, and if not for the pandemic, the 2009 to 2020 bull runs wouldn't have ended in just 11 years. On average, bull markets tend to last around 5 to 5.5 years, which means that, statistically speaking, the one that we are on might still have another 2 to 3 years left to run. So even though everyone is warning about an AI bubble, record high PE ratios, or the buffer indicator flashing rates, it's worth remembering that markets don't peak because investors are cautious. They peak when there's an external shock. Looking back at history, you can see that the triggers generally fall into one of the three types. It's either the Fed tightening cycle, like during 1956, 1966, 1968, 1980, and so on, or some unforeseen black swan events, such as the oil shocks, subprime crash, and the COVID-19 pandemic. And it is only in very rare cases that the market crashes due to overvaluation. And if anything, today's markets looks very different from 1999, when prices ran far ahead of fundamentals. Back then, earnings were flat while stock price exploded purely on hype. Today, both profits and prices are rising together. This suggests that this rally, even though it feels stretched, may be more of a reflection of real corporate strength than speculative mania. Now, of course, this is not to say that there isn't a bubble somewhere in the market. But unlike what the headlines suggest, where the entire stock market is in a bubble, the truth is that today's bubbles are more concentrated in specific corners of the market. The first and arguably most speculative sector is quantum computing. Stocks in this space have skyrocketed, even though most of these companies are still years away from commercial viability. Take IonQ for example. The stock surged by over 1000% from its 2022 lows, despite still reporting losses. So, the enthusiasm here is driven more by potential breakthroughs than by measurable progress, and that is a classic sign of a bubble. Another example is Rigetti Computing, one of IonQ's main competitors. Rigetti's shares have jumped more than 400% since mid-2023, even though the company continues to report widening losses and less than $60 million in annual revenue. Besides that, another emerging pocket of exuberance lies in the nuclear energy sector, with governments worldwide pushing for clean energy and AI data centers using more electricity than some countries. Nuclear has suddenly become the next big thing. But many of these firms are deeply unprofitable. For instance, Oklo, a Bill Gates-backed nuclear startup, soared more than 1,500% after its SPAC debut, even though it isn't expected to generate revenue for at least another 2 to 3 years. Similarly, NuScale Power, which is another small modular reactor company, saw its shares climb nearly 300% from late 2023. But then, what about the AI industry? Given that there are so many circular deals going around and people warning about a bubble, is there actually a bubble forming here? I would say yes, but it's mostly showing up in software companies and not so much in the hardware giants or cloud providers. For example, if we look at Amazon, it is still trading close to its current fair value. And even though Microsoft is a little overvalued now, it is not by much. Same for Nvidia. And on top of that, they are still supported by the strong earnings, free cash flow, and real demand for AI infrastructure. On the other hand, when we look at AI software companies like Palantir, it is a different story. Even if you assume a 40% annual growth rate for the next decade, Palantir still trades well above its fair value while pricing in years of flawless execution. So the bubble isn't everywhere, but it definitely exists within certain sectors and stocks. And as investors, if you don't want to get burned when the next crash comes, you need to avoid chasing hype and focus on companies that can consistently grow their revenue, net income, and free cash flow. Because when the next correction eventually comes, and it will, fundamentally good stocks will be the ones that will recover first, while the speculative names will be the ones that don't come back at all. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.